What's going on, penny boys and gals? It's MetaMatt here, also known as What the Duck on the Discord, and welcome to KDU Lite. This will be a two-part class on behavioral finance. So first things first, what is behavioral finance? Well, it's a branch of finance that studies how psychological and emotional factors influence financial decisions and market behavior. It's a field that combines insights from psychology and economics to better understand why individuals often deviate from purely rational and logical decision-making when it comes to money and investments. So think, the trading psychology classes that we do, but on steroids. Now you might be wondering why behavioral finance is so significant. Well, traditional finance theories have long assumed that individuals always act rationally, seeking to maximize their own skills and knowledge. However, behavioral finance recognizes that in reality, we're all subject to cognitive biases, emotions, and mental shortcuts that can lead us to make less than ideal financial choices. To illustrate this, let's consider a common phenomenon known as loss aversion, which we went over in detail in our Trading Psychology free series in the free education channel. According to behavioral finance, individuals tend to feel the pain of a loss more intensely than the pleasure of an equivalent gain. Our feelings and emotions are more intense when we lose $20 than when we gain $20. This means we often make decisions based on avoiding loss rather than seeking gains. For instance, a trader might hold on to a losing investment for too long, hoping it will recover, even when the rational choice might be to cut losses and reallocate capital. Behavioral finance doesn't seek to replace traditional finance theories, but rather enriches and complements them. While traditional finance provides a valuable framework for understanding markets, behavioral finance sheds light on the human element that can sometimes lead to unpredictable market behaviors. By integrating insights from both fields, traders and investors can make more informed and nuanced decisions. So while it is important to learn about fundamentals, meaning company finance details, SEC filings, insider trading, and the other topics we go over in week 4 of our premium 8-week course, and charting, like we go over in our premium 8-lesson charting master course, it's equally important to learn about trading psychology, because even the best charters or fundamentalists in trading can lose trades if they let their emotions get the best of them. All right, let's dive into one of the fundamental aspects of behavioral finance: biases and mental shortcuts, also known as heuristics. These are the psychological shortcuts and mental patterns that can significantly influence our financial decision making. Understanding them is crucial for traders. Let's go over some common cognitive biases, starting with confirmation bias. This is our tendency as humans to seek out information that confirms our pre-existing beliefs or opinions, while ignoring or downplaying evidence that contradicts them. In life, this can be refusing to eat a certain food that you might like because you were told your whole life that you wouldn't like it, even though in reality, you might. In finance, this can lead us to selectively interpret data in a way that supports our investment decisions, potentially leading to overconfidence. Overconfidence is another one. This bias involves an excessive confidence in our own judgments and abilities, often leading us to overestimate our knowledge or the accuracy of our predictions. In the financial world, overconfidence can lead to a risky investment decision or a failure to properly diversify portfolios because we know best. And in reality, we don't, because our judgment is clouded by overconfidence. Loss aversion is the strong preference to avoid losses rather than acquiring equivalent gains. It means that we feel the pain of a loss much more than we feel the pleasure of an equivalent gain. This bias can lead to holding on to losing investments for too long, hoping they'll recover. Let's talk about some heuristics, such as availability heuristic. This heuristic involves making decisions based on readily available information in our memory. For instance, if we've recently seen news about a particular stock performing well, we might be more inclined to invest in it without conducting thorough research. Represented in this heuristic is a tendency to make judgments or assumptions about a situation or individual based on how similar it is to a prototype we have in mind. For example, if we have a preconceived idea of what a successful investment looks like, we might use this mental image to judge potential investments, whether this is a chart setup, fundamental factor, or even style of trading. If an investment closely resembles our mental prototype of a successful one, we may be more inclined to view it favorably, even if we haven't thoroughly analyzed its underlying fundamentals or charts. By recognizing these biases and heuristics, we can strive to make more rational and informed financial decisions. Remember, being aware of these tendencies is the first step towards lessening their negative impact on our investment strategies. All right, let's delve into a critical aspect of behavioral finance: the impact of emotions on decision making. Understanding how our feelings can influence our investment choices is the key to making sound financial decisions. Emotions play a significant role in shaping our investment choices. Two prominent emotions that can often come to play are fear and greed. Fear can lead us to be overly cautious or even avoid taking necessary risks. It can make us hesitant to enter the market or cause us to panic and make impulsive decisions during market downturns. If you're fearful when riding a mountain bike on a mountain, that fear might cause you to make irrational decisions or turns or stops, and you can end up falling because of it. Or the fear can make it so you don't even go down the mountain in the first place and miss out on a good time. However, knowing when that fear is rational, such as fear of going down a huge mountain with no experience biking, is crucial. Our fear can stop us from making bad decisions, but at the same time can cause cause us to make irrational ones or keep us from making good ones. Greed, on the other hand, can drive us to chase high returns without considering the associated risks. It can lead to overconfidence and a tendency to hold on to investments longer than we should. Understanding and acknowledging these emotional influences is the first step towards making more rational and objective investment decisions. Managing them is the next step. How do we go about managing these emotions to ensure our decisions are based on sound judgment rather than emotional reactions? First up is to establish clear objectives. Define your investment goals and risk tolerance before making any decision. Having a well thought out plan can provide a framework for rational decision making. That's why our week 1 of our 8-week course goes over trading plans and is available to everyone. We even have a custom PB trading plan template you can use. You fill it out, you can post it in the Trading Plans channel so the guides and mentors can better understand your plan, goals, and objectives so that we can best help you as a trader. Implementing stop loss orders is another step. These are predetermined levels at which you're willing to sell an investment to limit potential losses. You can also use them to guarantee profits. Stop loss orders can help mitigate the impact of fear and prevent emotional decision making. Diversifying your portfolio is also super important. Spreading investments across different assets or asset classes can help reduce the impact of market volatility in a certain stock, sector, or asset class on your overall portfolio. This helps lessen the fear of significant losses. Another step you can take is to practice mindfulness. Being aware of your emotions and understanding how they might be influencing your decisions can help you make more conscious and rational choices. Knowing when to take a break and step away mentally from trading is also super important. You can also seek outside perspective. Consulting with community members, guides, shot callers, and other traders, or discussing your investment decisions with a peer can provide valuable, objective insights and help counteract emotional biases. These strategies are to help ensure that emotions don't cloud your judgment, allowing for more rational and informed financial decisions. Make sure to tune into class 29 for part 2. See you there, but until then, as always, I hope that you all make some bread.